So I'd like to welcome all participants to the first panel session of our 20th meeting of the Brazilian Finance Society. The topic of this session is on investors and market reactions to COVID. Just to clarify details of the session, this session is going to last 90 minutes. The idea here is that each speaker will present his paper for 20 minutes, and after all the presentations, we'll have questions and answers, discussions. Anyway, I would like to welcome questions from the panelists during the presentations, as well, at least clarification questions or short questions. And lastly, I would like to thank our invited speakers. I believe that no introductions are necessary here, and all participants anyway are anxious to hear you and not me. It's truly a great honor to have you, Harrison, Rolf, and Stefano. And I do hope to see you actually in Brazil soon. Some of you actually were expected to come here this time or next time. And I do hope we have this opportunity again to have you back in Brazil in the next few meetings. Without further ado, I'll pass the word to Harrison to present the first paper. He was supposed to be the moderator, but maybe I'll take over from now due to his request.
Great. Hey, thanks a lot.
I forgot to clarify. You probably saw that there are going to be questions and answers. Please send questions using the Q&A. We're not going to use mics here. Please send the questions, and we're going to pass to the speakers after their presentations. Okay.
Great.
Thank you, Harrison.
Hey, thanks, Ruy. Thanks, Ruy Allen, for organizing this. I guess happy 20th anniversary for the Brazilian Finance Society. I know Marco Bonomo, the godfather, is out there. So hello to Marco. And then to all of our friends in Brazil. I was going to sort of start off one of your famous YouTubers, Felipe Nito. I was watching his YouTube last night comparing the US and Brazil. We're the two world leaders in how not to manage COVID risk. So let me start with some of this this preliminary work with Nang Wang at Columbia, my colleague here, and Jin Changyang at the Shanghai University of Finance and Economics. So let me start off by just sort of talking about R0. So this is the expected number of secondary infections by a representative infected individual. Everybody has obviously heard a lot about R0. It played a pretty major role as far as managing COVID-19 risk. You know, it's emphasized by a lot of epidemiologists, and I think kind of more importantly, it's been used by the recent macro literature that tries to use these R0 estimates to forecast baseline infections absent some government intervention, right? So I don't need to kind of go through all the papers, but you know, these papers have gotten a lot of attention. I think the thing we want to point out, and I think this is particularly important, I think this is very, financial economist specific, which is, look, R0 comes with huge standard errors, right? Some of it, of course, is just some measurement error issues, but I think a lot of it, epidemiologists think, reflect the fact that transmission rates are extremely stochastic, right? That is, like, aggregate transmissions at the community level are highly unpredictable. So I think some of this is because of super spreader events, some of this might be weather or climatic conditions, some of it is pathogen mutations. I think all of the above seems to apply for what we're experiencing with COVID-19 as we're beginning to see, you know, very unexpected flare-ups around the world. And I think kind of the point that we want to bring, which is again a kind of a very financial economist perspective, is we should, you know, really model volatility, right? We should model the volatility of transmission, and that should play kind of a relevant role when it comes to managing COVID-19 risk for both, I think, health and also for wealth, or that is stock market valuations. So there's a few points we want to kind of bring across. So I think if you introduce basically aggregate transmission shocks to these deterministic, otherwise deterministic models, you can get pretty different forecasts. I don't want to kind of oversell that point because as I'll talk about, R0 is extremely high. So this is a very, very infectious infection. So that I think that's still kind of a very first order concern, but nonetheless, I think volatility should be used in the language of how we think about managing pandemic risk going forward. And certainly, I think it's hard to think about R0 if you're going to talk about financial markets. So there's a quote that I have from the Fed talking about how asset prices remain vulnerable to significant price declines should the pandemic take an unexpected course. So, you know, the language of R0 and deterministic models really cannot accommodate the notion of an unexpected course. Okay. So just kind of really quick, the paper's online. I'll just kind of emphasize a few points. So first, you know, we start with this. We're going to take an SI model. So that is, we're only going to have susceptible and infected. We don't deal with we don't deal with deaths, and we don't deal with recovered in the sense that a lot of this is just mostly for tractability reasons, as I'll kind of talk about. But we think it's actually a fairly reasonable model to talk about a lot of viral processes, and I think in particular COVID-19. First, you know, there's not a lot of evidence that people recover in some permanent sense. You know, I think in fact most of the news suggests that it's fairly temporary, and I think second, from the perspective of kind of what we're interested in terms of economics, infections, I think how many people are infected plays kind of for us the main role. So that's the main state variable. Okay, but otherwise the model is basically, we start with the classic SI model. So beta is this transmission rate, I is the fraction of the population is infected. We assume everybody could potentially be infected, and then gamma is the exit rate from the infection state. So all we do is we add, instead of having beta, we're going to do a parameter perturbation and have it with the stochastic rate beta tilde. Okay, and so basically you can think about beta tilde delta as the over some increment of time delta. You know, what's the fraction of the people that are getting infected? We're going to assume there's just going to be a stochastic component captured by sigma. Okay, and then we'll work with a continuous time formulation. So VZ, the Brownian, is going to be our main, what we call the aggregate transmission shock in the economy. So we estimate the parameters. You know, I think you can use very fancy models, but I think from our own experience estimating this process, you can also use pretty simple models. I mean, it doesn't seem to be sort of a huge difference in terms of what we're getting as far as COVID. We get a very high transmission rate, so beta, it's going to imply an R0 of 3. That's really a very, very infectious process. And I'll talk a little bit more later about how we estimate this. The exit rate is typically, I think people think about 7 to 14 days. And then more importantly, we'll emphasize this volatility parameter, sigma, in a second. So just to kind of put intuition a little bit of why people care about R0, R0 is defined literally as just beta over gamma in a deterministic model, right? And so if you solve out for the solution of that ODE, you know, you'll get that IT is just going to be I0 times some exponential to the gamma R0 minus 1. So that's why everybody's fixated with this R0 being greater than 1, right? Because, you know, in some short run, that's your explosive growth process. Of course, this is ultimately a limiting process because, you know, at some point, there's going to be some herd immunity in the population. And then, of course, you know, what people do is you just take an R0 and you project out using a deterministic model what you think the infection processes will be, right, at over some period of time. This is the counterfactual infection forecast that macroeconomists like to make. So for particularly the work of Atkinson has been very influential, right? To think about, you know, if you change different parameter values beta, how does that change the state variable IT? And that determines the trade-off that the economy has as far as trading off health versus economic shutdowns. So what we do, of course, is we just introduce the sigma, right? So you're going to augment the deterministic process with this sigma IT 1 minus IT DZ process, okay? And then when you do the exact same approximation in the beginning, what you find is that the process is now not really only dependent on R0, but really I think the more relevant thing is just determined on the ZT, that is the aggregate transmission shocks, okay? And the ZT process is familiar to all of finance economists. It's basically, this is approximately like a geometric rounding motion, right? So depending on realizations of the ZT shock, that really drives basically the infection process. And so if you're really unlucky in the beginning, right, you can be really in a bad state. But on the other hand, if you're very lucky in the beginning, you can be in a pretty good state. And in the beginning, ZT is effectively permanent, right? So this is, I think, a very different perspective about managing COVID-19 risk compared to R0, right? And I'll talk a little bit about the ZT process later on as far as how it matches, I think, some of the data that we see. So just to summarize, I think kind of the first part of risk management, as we all know in finance, is, you need a good process to capture risk. Yeah. And we think that a process that augments essentially the SI model with a parameter federation in terms of this aggregate transmission shocks is I think, a reasonable model that can speak to what we want to talk about. And then I think the other nice thing, of course, is you can calculate conditional distributions. It's a pretty nice process. You can kind of use the Kolmogorov forward equations to calculate conditional distributions of IT. You can also introduce a vaccine. A vaccine, I think, plays a particularly important role. So the way we can introduce a vaccine is just there's going to be some stochastic arrival time given by this jump process. Okay, and then basically when the jump arrives, you go back to your you get rid of all the infections. It's admittedly a very exogenous model for vaccine arrival, but I think it's kind of a reasonable starting point. So in this model, then there's really kind of two types of risk. There's aggregate transmission risk, which is these DZ shocks, and then there's going to be basically a vaccine use, which is these DJ jumps. And then otherwise, I think in an asset pricing framework, it's pretty standard. I think, again, sort of the nice part about this language is that you can plug it pretty easily into a standard valuation framework. So one way to think about it, and I think Ralph will talk more about this in his work, is that, the COVID arrives unexpectedly and you're now basically in a new regime, okay? So you can think about it as sort of like a pre-pandemic versus a pandemic regime and then potentially a post-pandemic regime. Okay, and in the pandemic regime, you might kind of imagine lots of different ways in which the infection process could affect cash flows of companies. It could affect the volatility of companies. That is, it could change the betas of companies. Okay, and then of course DZ would naturally also be potentially in the SDF as well. So you can write down equations 5 and 6 that are very familiar to just asset pricers, except that, we're just going to introduce essentially this DZ shock along with this additional state variable IT. Okay. But otherwise, you can kind of solve the pricing equations. And so, of course, in this type of model that we write down, which is very familiar to everyone, everything kind of scales out by the level of earnings, YT. And so we'll be working with price earnings ratios. Okay, that's given by equation 7. I think a couple of things to note. Beta, which is this transmission rate, from the perspective of asset pricing, actually, right? And I think this is kind of one of the conundrums that I think markets face right now is that if you think there's basically this infectious process, of course, what should happen is you think that there's risk associated with these stochastic transmission shocks, and you should pay. There should be some risk premium associated with that. That's a very natural model, okay? And so, of course, that would basically imply that from the perspective of the market, the transmission rate, beta, it's actually going to be much higher if you kind of do a risk adjustment, okay? So the market should react, I think, on a kind of a risk principle very severely to the notion of stochastic aggregates, stochastic transmission shocks. And so there's a number of valuation implications of this process, which I won't kind of go into, but that's probably all familiar to everybody here. It's given that it can kind of influence both the SDF and also the earnings process. Now, I think the other big thing, of course, is the vaccine, right? If you think that basically what's happening is when the vaccine comes, we all go back to normal, okay? Then, of course, that's also going to have its own price, right? That's going to be given by lambda Q, right? There's going to be also some potential vaccine arrival rate and also premium for the vaccine vaccine shock. All right, so that's the basic kind of outline. It's essentially just saying, look, we should kind of take some model with some risk process that we're familiar with in finance, and then you can kind of then talk about a bunch of stuff. So there's nothing I think particularly new in terms of an intellectual asset pricing landscape, except that I think that the process itself is interesting to study and to reuse the tools of finance to study this transmission process. Okay. Let me quickly go over the data for those of you guys who are interested in this estimation, because I think some of it is kind of in epidemiology. It gets to be a little bit hairy, and there's a lot of papers written about this estimation. But from our own experience, it's pretty straightforward to get I think sensible estimates of these reproduction numbers. And then the other thing I'll kind of flag is the following. R0 is a concept that starts at the beginning, before the infection, where you think that most of the population is susceptible, right? Yeah. And the point, of course, is that if you introduce aggregate transmission shocks, then there's also a notion of RT, which is the reproduction number itself over time will also be a random variable, right, that you can solve for. And that's exactly sort of like what the notion of an aggregate transmission is that R0, RT can kind of bounce around over time depending on these shock CT. Okay, so what we're going to do is we're going to estimate what do epidemiologists do is that we would like to get a sense of how infectious the process is before there's a lot of government intervention, because that makes things much more complicated, right? Because then ultimately you also need to talk about an optimally suppressed, or maybe in the case of the US and Brazil, non-optimally suppressed COVID process. So we'll take some data from Johns Hopkins. IT again is the number of net outstanding cases. We're going to focus initially on a set of countries that had a lot of air travel connected to China. So this just plot shows you basically kind of what the raw data looks like for China, Singapore, Italy, and US. You can see, for instance, China had a huge amount of infections in the beginning and kind of they tapered it down. Singapore has kind of gone through multiple waves. Italy had that big wave and kind of also tamped it down. And the United States, of course, is now was tamping it down and is now going through another wave again. And typically what epidemiologists do is you don't estimate the gamma. The gamma is you just physically set to something like 5 to 14 days, which is what we do. And then you can apply some standard OLS estimators for beta and sigma squared, and kind of the usual, given that this is a standard diffusion, you can just use quadratic variation, right, to estimate these parameters. And then this is where I got the numbers from, right? So basically our R0 is 3. There's a pretty wide standard error actually that people don't really emphasize. You can go anywhere from 1.9 to 3.75, which is a pretty wide range. Yeah, but I think that's kind of realistic about this process. And then we make some conditional forecasts. So basically we just use the data from the pre-intervention period, which is before March. And then we make some forecasts for March and April going forward. And so what's nice about working with the process, of course, is that, you can also generate, I think more importantly than simply generating the mean forecast, is that you can generate standard error bands as well, right? Which is sort of precisely kind of what we want to do. So these red bars represent standard error bands, and these are conditional forecasts for a bunch of countries. And I think kind of for the most part, the forecasts do okay. I think, you can see that, of course, like for countries such as China, right, which is shown here, and also for South Korea, they bent the curve quite early, right, relative to other countries. That's why you see that the model just doesn't work, exactly because governments have kind of intervened, right? You're now no longer in so the way I think about the process we're doing right now is this is a process pre-intervention, right? Non-optimally suppressed or non-suppressed, okay? And we're generating these kind of counterfactual forecasts. All right, so let's look at the forecast for the US. So a few things to kind of note that I think is not completely appreciated. So I think it does make a big difference if you use a deterministic model versus a stochastic model, right? Because here in the US, for instance, what's gonna happen is if you do a deterministic model, you're gonna generate, right, very predictions that at a reproduction number of 3, you're gonna get to something like 67% of the population infected like in 6 months, right? These are forecasts that we generated starting on March 1st, okay? And I think this is all the numbers that everybody was talking about, including Angela Merkel in Germany, right? You know, this is kind of the R0. These were the numbers that people were talking about. But of course, if you allow for sigma, and if you think that there is an aggregate transmission component of it, right? Which I think most epidemiologists think that there is, you know, you can see that the forecast is pretty different. So, you know, for instance, even 4 months out, you know, whereas you're already basically close to steady state for deterministic model, because there's volatility, right? There's going to be a lot of bouncing around essentially of these infections process. So you get only like 16.5%. You know, I would argue that I think for the US, this stochastic process seems to kind of be capturing a bit better relative to a kind of a purely deterministic model. Exactly, I think, because, you know, these shocks seem to, you know, there are just shocks that are not easily controlled or easily predicted, okay? So just for some other purposes, you know, it's easy to calculate some analytic distributions, so I won't kind of go into that. And then just I'll kind of, in the last couple of minutes, talk a bit about comparative statics. So for instance, I think there's a lot of discussions about, from the perspective of epidemiologists, of bringing R0 below 1. Now, I think maybe for some countries, that's just a really tall order. You know what I mean? I think New York now is kind of hovering around 1. It's like 0.9. Yeah. Whereas I think some other countries like South Korea can really smash that number. But I think one of the things we would emphasize is that, you know, if you account for stochasticity, even if you're sort of near 1, right, you could already generate a lot. Even if you're a little bit above 1, you can generate a lot of huge benefits. Yeah. So for instance, we ran some numbers for like an R0 of 1.75, you know, you can kind of then, you know, basically do what epidemiologists call just like a slow burn, right? You know, you're just kind of treading water, which is, I think, basically what the US is right now. It's kind of like barely treading water, keeping the thing from kind of exploding. And one thing to note is that vaccines, okay, which I'll come to, vaccines don't really help that much, of course. You need some of these government interventions exactly because, you know, even if you give 6 months or a year, right, you can still get extremely high infection numbers, right, absent some amount of intervention. The vaccines are just not going to come fast enough to deal with an R0 of like around 3, okay? And then we talked about economic damages or financial damages. So one thing I'll kind of note is that, you know, this is, I'm not going to go through all the parameter calibrations and stuff. They're pretty standard for asset prices as well. I'll kind of make 2 points. So we should expect for the R0s that we're getting of 3, you know, I think we should expect, given all the risk premiums and everything, for valuations to be pretty severely damaged, perhaps much more so than what we're seeing right now. But if you have a vaccine and the market really thinks the vaccine can come pretty fast, right? That really kind of neutralizes a lot of stuff, okay? So that I think kind of there's a notion of the disconnect between where I think people talk about valuations and why the valuations seem disconnected. I think some of it is certainly tied to the fact that I think the market is probably expecting a fairly quick, historically quick vaccine arrival. Okay, and I'm going to stop there and give my time to Ralph then to talk next. Thank you.
Thank you very much, Harrison. As planned, like we're gonna move to the next presentation and we're gonna have a joint discussion of all papers afterwards. So maybe Rolf, do you wanna take over now?
Yep, that sounds good. So let me share my screen. Can you see my slides? Yes. Yeah, perfect. Okay, great. Well, thanks a lot for inviting me. This is joint work with Niels, and like much work in this area, of course, it's all recent in progress and things like that. So our starting point was actually very early on, simply because we were trying to understand what was going on with asset prices in response to the developing coronavirus. So joint work with Niels Korfman, my colleague at Chicago. So obviously, there's a lot of discussion about the path of sort of expected growth as a result of the ongoing crisis, and given that asset prices are forward-looking, there's been a lot of discussion about what financial markets tell us. Like Harrison mentioned, like people are struggling to sort of make sense of like where valuation levels are currently, in particular in the stock market. And so what we're going to sort of like explore in this paper based on earlier work is to sort of look at a related market of dividend futures and what they tell us about the path of expected growth, both in the US and in Europe. Okay, so just to sort of make sure we're all on the same page. So what you see over here is the evolution of the stock and the bond market in Europe and the US. So the top left panel is the US S&P 500. The top right is Euro Stoxx 50 index. Then the bottom left is US Treasuries, the return on a 30-year bond, and then the bottom right is the return on a similar maturity German bond. And so sort of like on the vertical. Sort of in vertical lines, you see some of the key events. So let me just sort of like talk about the US first. And so what you see is that when there's lockdowns being imposed in China and then subsequently in Europe, there's not much happening with the stock market. And then it suddenly starts to drop very sharply. And then really once there's the EU travel ban, national emergency, you see this enormous decline of like something like 35% in the US stock market, which then turns around following sort of like monetary and fiscal policy announcements. And then it's been drifting back up to the point pretty much where we were before the start of the COVID crisis. Now, if you want to interpret, just to sort of like get into the mindset. So if you want to interpret these declines just in terms of fundamentals, then this is a pretty disastrous shock. So just to give you an idea, like for the stock market to fall by 30%, and you think of the stock market as being the present value of all future dividends, then if you look at the data, the first 10 years of dividends only makes up about 20% of the value of the stock market. So that means that if you want the market to fall by 30% just because of like cash flow news, that means something like corporate America is not going to pay out dividends for the first 10 years. And in addition, you're going to lower dividends by a lot for the subsequent period as well. And so now there's good and bad news. So the good news is that typically that's sort of not why markets move, because we know there's a lot of variation in risk premia. But of course, the bad news is it doesn't tell us very much then by looking at the stock market about the path of expected growth going forward. Okay, and so what we're going to do is we're going to look at a related market, dividend futures, to sort of like tell us something more potentially about growth. So what we're going to do is we're going to think of the value of the stock market, ST over here, as the present value of all future dividends. And so the market as a whole, primarily we know moves because variation in expected returns, and so in particular at long horizons. And so what we're going to do is we're going to sort of like strip down the market, and we're going to look at each of these individual components as prices of dividend strips. And so what is PTN over here? That is the price of a claim to an N-year dividend. So it means that if I pay that price today, I'm going to receive all the dividends that are paid by firms that are included in the S&P 500 in, let's say, 2025. Okay. Now, once we sum up all these dividend strips across all maturities, it's going to get back to the market. Okay. But what we've shown in earlier work with Jules van Binsbergen is that these dividend prices are actually very informative about future growth, more so than the stock market itself. And the good news is we observe these dividend futures or these dividend prices for the first 10 years, both in Europe and in the US, also in Japan and the UK, and potentially other markets at this point. And so we're going to look at the evolution of those prices side by side compared to the stock market, and we think we're going to learn quite a bit from that. Now, what we observe is not exactly dividend prices, spot prices, but we observe futures prices. So what is it that we can directly read off like financial markets? So we have these prices over here, PTN. So those are the dividend strip prices. It's convenient to sort of like write it as the price today is equal to the current level of dividends. Think of that as the January 1st value before anything happened. Then you get the expected growth by maturity over the next like, let's say 1 or 3 or 7 years. And then you get a maturity specific discount rate mu TN over here. Okay. Now, as I mentioned, we don't observe the spot prices PTN, but we observe the futures prices. And so just by sort of like arbitrage relationships, what we observe is FTN over here, the futures price. And that one is driven by two things. One is the expected growth rate over the next N years. And then there's a risk premium component also over that same horizon. And so that means much like nominal and real bonds that are differentiated by maturity, here we have asset prices that are very closely tied to economic growth that are differentiated by maturity that we can observe for different markets. Okay, and so so what we're going to do is we're going to sort of see how did those prices evolve during this crisis, and what can we learn from that about economic growth, both in terms of dividends and GDP. Okay, so what we do in the paper, it's very much a facts paper. So we're documenting the basic facts about sort of stock markets and dividend futures prices during this episode. Now, the reason why we think this episode is interesting, beyond, of course, its sort of magnitude, is that it's kind of a unique shock from an asset pricing perspective. So normally, at the onset of a crisis, think about the 2001 tech crash or the 2008 financial crisis. We don't really know what the duration of the shock is going to be, whether the long run impact is going to be worse than the short run impact. Here, with the pandemic, you know that given these sort of extreme measures that are put in place, where you get lockdowns and things like that, the long term sort of impact may still be quite bad, but at least the short term impact, when everyone is forced to stay at home and businesses are shut down and things like that, the short term impact is going to be more severe. And so we're going to learn about sort of the pricing of those short term shocks compared to the longer run shocks. So in that sense, we think it's interesting to sort of zoom in on how markets price those different shocks at the long and the short end. Then we're going to use these prices to sort of see what we can learn about growth expectations. And then in the paper, like Harrison mentioned, we have a simple sort of pricing model. I'm not going to show you the equations, but as I talk through the facts, I'm going to tell you at least how the model interprets the data. Okay, so what are the data that are available? So what we're using over here are data on dividend futures that are exchange traded. So in the US, you can get data from the CME, and in Europe, you can get data from Eurex. Now, there's also a large over-the-counter market that one can get data on in principle through some of the larger banks. But everything we're using in this paper is exchange traded, and so you can easily sort of follow these markets yourself. Now, one feature that's important is how these contracts are structured. So the way it works is that if you buy, let's say, the 2023 futures contract, then the way it works is that you accumulate all the dividends that are being paid out by firms that are included in the S&P 500 during the 2023 calendar year, and then the payoff is going to happen in December of that year. And so that means that as you roll through the year, the maturity is going to shorten, and so like we do normally in the term structure literature, we're going to interpret sort of those contracts to get a constant maturity, prices. We're going to use mid quotes at close for the US and the volume weighted average price during the day in the EU. And I'm going to show you that sort of these markets are actually very liquid, and how you deal with small things like bid-ask spreads are going to be very inconsequential for anything I'm going to talk about in this paper. Okay, so just some of the key events that we're going to emphasize. So we think of it as kind of three phases. So the first phase is when the crisis starts to evolve from China, spread sort of globally to Europe, and that's when you start to see the first sort of lockdowns happening in around sort of March 5th to March 12th. Then you also get a travel ban in the US that limits travel from the EU. And so then you see a very large response in the stock market. That kind of continues for the subsequent week. First fat action is at March 15 when QE restarts, but then in particular on March 23rd when it's kind of the whatever it takes speech, and prices respond very sharply, both in credit markets, bond markets, equity markets. And then sort of at around the same period, and you'll see there's also sort of the fiscal stimulus measures that have been taken, and so that has a big impact on markets. And then we're going to sort of track the recovery. Okay, so what I'm going to sort of show you kind of side by side is how the stock market and the dividend futures market evolve during that period. So the left panel, you see the dividend futures. The right panel, you see the stock market. And so during the first period until March 5th, the way you should read this left graph, the blue line is for the S&P 500, and the red line is for Euro Stoxx 50. The different points are different maturities. And so the fact that this blue line over here is very close to zero means that dividend futures barely move during that period. And again, that's kind of like puzzling if you look at the response of the stock market, because you see the stock market in the US already dropped by something like 10%. Okay, and that's when sort of Niels and I got interested, because like the one sort of unique feature of pandemics is that if it were to escalate, it's going to have a large impact on the first 1 or 2 years, and then potentially there's going to be a fallout thereafter. But at least the short-term impact should be more sort of like should be larger than the long-run impact. And so you don't see anything happening in dividend futures on the short end, but there is movement on the long end, and that's sort of like reflected in the stock market. So that seems to be related to shocks, to uncertainty, like risk aversion sentiment, whatever your favorite story is for why there's excess volatility in the stock market. Now, if you then sort of like move on to the next period where things kind of escalate in Europe and in the US, then you see dividend futures move very sharply. So the market obviously collapses, then you get the sort of the close to 35% drop in the market. But you see that short-term dividend futures, they do respond very sharply now. The one-year contract, not that much yet, in part because dividends have been declared already, in part because like dividends respond with a bit of a lag. And so you see that the 2-year contract drops by something like 35% in the US and like 45% in Europe. Okay, and then there's some evidence of like recovery thereafter. Now the next period is quite interesting from our perspective, because that's the moment where the Fed steps in and when there's the fiscal stimulus response in the US, and markets sort of like swing around very, very rapidly. Now if you look at dividend futures around that same period, the short-term prices actually drop. And so instead of this being sort of like something about sort of the near term, the recovery is really sort of like a very long-term phenomenon, as opposed to a short-term decline as opposed to an improvement in the short run. And so in the model that we write in the paper, the way we think about it is to why these parts move differently, is that during the period where the virus is sort of like going around and there's no vaccine yet, there's all these kind of like social distancing measures, lockdowns, and what have you, and there's an economic cost associated with those measures. That's really what's influencing the short run, and there's very little that Fed action or fiscal stimulus does to that part. That damage is being done. We'll learn about it, and there's risk associated with that. But then there's a second part, is that like as this sort of goes on, there's more bankruptcies that will happen and may weaken the financial sector, and that may trigger like a financial crisis. And that's sort of like the long run sort of like implication of the pandemic, and that's really what's moving the longer end of the dividend curve. And so you see that like the measures that have been put in place are primarily helpful to sort of like move the long end of the dividend curve, as opposed to the short end. And sort of in the model, the way sort of that is being interpreted as that the probability that the sort of a sharp deep recession escalates into a full-on financial crisis is being mitigated, at least sort of like as implied by these asset prices. But then you get the subsequent recovery, and you get sort of recovery both on the short and the long end. And that's sort of like where things stayed at this point. And so you still see that dividend futures are down on the short end, something like 20 to 30% in Europe. In Europe and in the US. Okay, so what can we learn from that in terms of dividend growth expectations? So we're going to first give a lower bound, and then conditional on once we have the lower bound, we're going to sort of like move to sort of like a forecast, but we need more assumptions for that. So remember that from what I showed you before, is that the dividend futures price depends on the expected growth rate and the risk premium component. So that means that over a short period of time, that if you see dividend futures prices change, then that's telling us something about the change in expected growth or the change in the risk premium component. And we're going to make the assumption, which we think is very conservative, is that over this period, risk premium did not go down. Okay, so we're not going to take a stance on how much they went up, but at least we think they went up. And so that means that the change in growth expectations is bounded from below by the change in futures prices. Okay, so this is something we can directly read off market prices. And so what you get is the following lower bound. The horizontal axis is maturity. The vertical axis is the lower bound and expected dividend growth. And so you see that in the US, it sort of like bottoms and flattens at something like minus 20%. In Europe, it's actually a sharper short-term response, but then like there's a bit more of a recovery thereafter. Now you may wonder, well, these are like lower bounds. Are they sort of like very weak lower bounds, or is this kind of informative? So in order to look at that, we go back to the financial crisis and do exactly the same calculation, and ask at the bottom of the financial crisis, like, what do these dividend futures look like, and what is the subsequent path of cash flows? And so what you see over here, the left panel is for the US, the right panel is for Europe. And in each of these panels, you see 3 lines. So one of them is, so the blue one over here is the lower bound during the financial crisis. The yellow dashed line is the lower bound during the current crisis. And the red line is the realized dividends after the financial crisis in the US and in Europe. And so what it shows is that at least for the first couple of years, like the dividends as predicted by dividend futures by this lower bound, using dividend futures, closely tracks the actual realization. Okay, now obviously these are just, I mean, it's just one observation, but at least it shows you that this lower bound may not be very weak. I mentioned sort of this issue of like liquidity. So here you see that these markets actually have grown quite a bit. So here you see the price dynamics at the bid and the ask, and they're like pretty much on top of one another. So anything that we're talking about here, like liquidity effects, are not very important. So the last thing we do is to look at growth expectations. So what we're going to do here is to do a simple forecasting exercise, like we've done in earlier work with Jules van Winsbergen. So what we do is we take dividend futures prices, normalize it by the current level of dividends, called the equity yield, and we're going to use it to forecast dividend growth. Okay, and it turns out that these equity yields are really good forecasters of future growth, like the R-squared you get is something like 65%. Okay, so there's a big chunk of like variation over the next year that you can forecast using these futures prices. Now, if you then want to map it to GDP, you need sort of stronger assumptions. And let me tell you what we do. So observation number 1 is that the cyclical component of GDP and of dividends is very strongly correlated. And so it's something like 56% over the period from like 85 until now. There's 2 important differences though. First of all, you see that the correlation is much higher during downturns. And secondly, there's some sort of like some asynchronous movements where sometimes dividends fall first and then GDP, and sometimes it's the other way around. And so in order to connect dividends to GDP, we're going to sort of like take into account both adjustments to get a mapping. So we're going to look at 2-year growth rates to get rid of some of these non-synchronous movements. And secondly, we're going to only use sort of observations where dividend growth falls below sort of the unconditional average, so that we focus on downturns. If you do that, you estimate a slope coefficient of like 0.2, so that means that a 1% change in dividends translates to a 0.2% change in GDP. Okay, so with that one in hand, you can plug in the forecast for dividend growth, and that's our forecast for GDP growth. Okay, and again, that comes with like significant uncertainty given the environment we live in. So if you look at that, then this is the dynamics of dividend growth, left panel, and GDP growth in the right panel. And so you see that it falls by as much during the worst period. It falls to as low as like minus 30% in the US and minus 40% in Europe, but it recovered quite a bit since then. So the dividend prices have come up quite a bit. If you look at GDP, it's kind of the same story because of course these are perfectly correlated. And so now the decline in GDP one year out is like minus 2%, and it's minus 3% slightly worse in Europe. Okay, so let me conclude there. So I want to sort of like finish off with like one discussion sort of like point that maybe we can, or may come up later on. It's sort of like, what about the current level of the stock market, like current level of valuations in the stock market, and to what extent sort of like can we say something about it? I think I want to sort of like separate 2 points. One is that in order to learn about growth expectations, looking at the stock market may be a very poor guide. We know it doesn't forecast growth very well, and we think dividend futures are much more closely tied to growth. Now, in terms of like interpreting like where the current level of the market is, I think there's been sort of like three narratives out there that seem to be sort of like generating this conundrum. So first, like one story that's been out there is people say like, well, there's been a decline in yields, and just by sort of standard discounting, the value of the stock market should be higher. Well, that argument like goes against sort of like a lot of the evidence we have, or the evidence we have over the last 25 years, because stock and bond markets have been negatively correlated. And so it means that as yields sort of like fall, normally sort of like the stock market falls as well, at least during the last 25 years. Now that relationship though is not, that correlation is not very strong. Okay, and so if you make a scatter plot of like 6 month changes in yields versus the stock market, the recovery that we have seen compared to what we have seen in the bond market is not unusual at all. So I think that it's not far from the trend line in that sense. What is surprising is of course, the comparison to economic activity. So I think the fact that one has to explain is that normally when economic activity like comes down so much, there's lots of like movements in terms of risk premium, sentiment, risk aversion, what have you. And that doesn't happen now. And so maybe it's consistent with like a short-lived recession, but it is unusual if you compare it to other downturns. The third narrative that's out there is that sort of there's been a lot of optimism by, let's say, a group of households that rushed into the market, and that sort of is moving prices. Now, if you look at the flows there, they're very small. And so in order to make that story work, you need to have a pretty inelastic market at a macro level. And so in some recent work with Aggregate, we're sort of exploring that theme. But I think sort of like the real sort of puzzle is between the real economy and prices, not so much between bond markets and stock markets. So that's it from my side.
Great. Well, Rolf, thank you very much. Stefan, you want to take over? And then I guess Rolf already raised a few points to be discussed afterwards. So, related to the next paper as well. Stefan, you're on mute. Is it locked somehow?
Unmute. Okay. Sorry, I saw my screen, but then I couldn't unmute myself. You guys see my screen?
Yes.
All right. Okay. So first of all, thanks a lot for inviting me to present this paper. This paper is joint work with Matteo Maggiori, Johannes Strobel, and Steve Utkus at Vanguard. And so the question that we're trying to address in this paper is the following: how do stock market expectations and trading activity evolve during a stock market crash, and in particular, how did they evolve during the recent COVID crash? So now this paper builds on a collaboration that we have started a few years ago with Vanguard, and we kind of specialize, we kind of use this ongoing project to look to focus specifically on the current crash. So because the entire paper builds on this project with Vanguard, let me tell you a bit more about that before I go into the details of this paper. Okay, so this project started in 2017, and since then we've been running a bi-monthly survey of Vanguard investors. And basically, every 2 months, what happens, we send a large number of emails to people who have accounts with Vanguard. Now, these are mostly retail investors. Even 80% of the people we survey are retail investors, and 20% have pension accounts or retirement accounts. And basically, because we send a large number of emails, we get a large number of responses. And so you should think of our survey as having a relatively short time series, but a large cross-section. Okay, we have about 2,000 responses for each wave. Okay. So 6 waves per year every 2 months, and we're covering the last 3 years. Okay, so what do we ask in this survey? I'm not going to give you the details of literally every question we ask, but think of it as a very short survey that basically tries to elicit the expected stock returns and GDP growth at the short and the long horizon. And also we try to ask the investors what's the probability of extreme events. And what I'm going to focus on today will be the probability of an economic disaster. So think of it as the probability of a stock market drop of more than 30% over the next year, and the probability of GDP growth of less than -3% per year over the next 3 years. Okay, so let's say a 10% total drop over the next 3 years. So it's a short survey, and that means that we're gonna have several of our respondents who actually respond many times, which also gives a panel dimension, so we can actually track how people change their beliefs over time. So really, the key kind of starting point for this project was that we have a lot of surveys around, and we have a lot of data, or we have at least some data on how people trade and what their portfolios are. but we have very weak links between the two. It's very rare we see investors' beliefs and their portfolio. So that's kind of really where this project was born. And so the idea here is that because we are surveying Vanguard investors, and we know who the investors are, we can actually go in Vanguard and check what their portfolio and trading activities are. Of course, we don't see the identities of the people, but Vanguard can do the link for us. And so we have explored some of the patterns from this data in a paper called 5 Facts About Beliefs and Portfolios, which basically we look at kind of general patterns that emerged from this data over the last 3 years. And instead, in this paper, we're going to go back into this survey and explore the patterns specifically during the last during the crash between February and April. Okay, so just to give you a bit of a sense of the period we're covering, this is okay. So this is a plot that goes from January to April, and you can see the solid line here is the price of the S&P 500. Okay, you can see very clearly the crash and the recovery up to April. Now you can see these gray bars are basically capture the timing of our survey. And as I told you at the beginning, these are bi-monthly surveys. So we had a regular wave scheduled in February, mid-February, and with a regular wave scheduled in mid-April. But when we started this project a few years ago, we thought, what would be interesting to leave us open the possibility of running another wave at short notice, just in case something interesting happens in the markets. And for many years, nothing interesting happened in the market, so we didn't actually activate this feature. But then we saw it in March, we saw the market dropping like a stone, and we decided to run an extra survey. Okay, so basically in mid-March, just basically, we didn't exactly get the bottom right, we got pretty close. After a 20% drop in the market, we ran an extra wave. Okay, so this paper is going to focus on what happened between these 3 waves. Okay. So I'm going to start by giving you a sense of how these last few waves are different from what I had happened before. Okay, so just to clarify one thing, you see that the 3 waves really are capturing, the February wave was just before the crash, then there's a March wave, which is just at the bottom, basically, and then there's the April waves that the recovery. Okay, so these are the last 3 waves. This graph plots is going to cover the entire period we survey, which starts in 2017. Okay. So each dot here corresponds to a wave. What I'm plotting here is the cross-sectional average to the question of the answer to the question, what's expected 1-year stock return. Okay, so we're looking only at time series variation. We're collapsing all the cross-sectional variation wave by wave. So what do we see? We see that when we started the survey, on average, people expected a 5% return of the stock market over the next year. And that number has fluctuated, not very wildly, but it's fluctuated over time. And then, just before the crash, you can see that it peaked at about 6%. And then, when the crash occurred, the crash went down all the way to 1%. And so, first of all, you see this kind of major change in people's expectation. People just became much more pessimistic going forward. And the other interesting feature is that even though the market kind of really recovered quite strongly already in April, by then, expectation really did not recover. Okay, so it's kind of there's been a very strong asymmetry between what happened to the stock market prices and what happened to expectations. There's been kind of a persistent change in the expectations, and you see something similar when you start look at the probability of a disaster. Okay, so this is the answer to the question: what's the probability that the stock market return we lose more than 30% over the next year? And you can see again, this probability was about 5%, which is kind of close to the historical numbers. And again, the fluctuation in this number was very small over time, but then it spikes just after the crash. Okay, so we see now the probability is about 8%. So basically, you see something that kind of looks like an increase in perceived risk after the crash, an increase in pessimism after the crash, which is consistent with some sort of extrapolative behavior of people, which saw this huge crash before them or behind, and when looking forward, they kind of extrapolate this negative output. Okay, so these questions were about prices and returns, and as Ralph mentioned, one of the most interesting questions that really come out of this episode is how do we kind of reconcile what happens to the stock market and what happens with the real economy. Now, Ralph is mostly working with dividends, and you saw how he works, how he links with GDP. We never actually asked about dividends. We just asked about GDP growth. Okay, and so this is what we see about this, retail investors' expectation about short-term GDP growth. The short-term is actually 3 years. Okay, that's the way we have defined. So this question here is about, it asks basically what you expect for the yearly growth rate for the next 3 years. Okay, and you see that people were expecting before, when we started about 3%, when just before the crash, they expect about 2.8% growth, GDP growth per year. And there has been a deterioration in the expectation of GDP growth from about 2.8% per year to 2.2% per year. Now, I should say that, as you can see, investors as of April, they were still, they still expected 2% per year growth over the next 3 years. And it's useful to kind of put this in context with other forecasts of GDP growth. So if you look at, just to give you some reference points, okay, if you look at the IMF forecast also as of April, they expect about 0.3% growth for the next 2 years. If you look at the Wall Street Journal survey of professional forecasters, the average forecaster expected a 1% growth per year over the next 3 years. And if you look at what happened during the financial crisis, the realized GDP growth was about 0.3% per year. Okay, so this is all to say that people, at least our investors that respond to a survey, they basically like everybody else, they expect a not that terrible growth over 3 years, because everyone is kind of assuming or kind of implying there's going to be a kind of a short-term crash but then a recovery. And I guess there's disagreement about the level of the recovery expected. Our investors are relatively optimistic compared to what we see in other forecasts. Now, all these numbers so far were about just aggregate statistics. So I didn't show you anything about the dispersion in beliefs across people. Instead, what this graph is showing you is a smoothed estimate of the density of answers to the question about 1 year stock returns. So you see, we are focusing here on the last 3 waves. So we have the wave before the peak, before the crash, is this dashed line here. That's the February wave. Okay, and you can see here the dispersion of answers. Okay, so you can see that most people were expected a growth rate of, expected stock returns to be somewhere between 0 and 10%. That's really where most of the mass is, with some outliers kind of above and below. Okay, now March and April are these two distributions you see almost completely overlap, which again signifies that there hasn't been really a recovery of expectations between March and April. And you see that several patterns here. So what happened between, when the crash occurred? First of all, you have this kind of shift in the mean towards, toward the shift down to the mean. You can see, the mean distribution has dropped. But you also see an increase in dispersion, so an increase in disagreement between investors. Okay, so the variance, the cross-sectional variance of this distribution increases. And you also see a flattening of the left tail. So, a much larger chunk of investors now believe that the expected stock returns are negative over the short term. Okay, so there's been a very large change in the cross-sectional distribution of beliefs. All right. So next, I want to show you, I want to kind of dig deeper into the panel dimension of our data. So as I mentioned at the beginning, one of the nice features of our survey is that we have the same people responding over time. And so we can track, how individual behavior changes, kind of taking out the kind of individual fixed effect. Okay, there's some people that are just always optimistic, some people are always pessimistic. We can now track each person, how they change their behavior over time. So how we're gonna do that? I'm gonna look at the pre-crash wave, which is February, and we're gonna sort people into buckets of optimism. Okay, so we're gonna beam them in people based on their beliefs in February, and we're gonna then track how they change their behavior over time. So let me show here, let me go slowly to this table because this table contains a lot of information. So first of all, this table has 4 rows. Each row corresponds to a bin of people based on their expectations in February, okay? So these guys here at the top are the people that already before the crash, they expected the crash, okay? They expect the returns to be negative. If you go down, you see more and more optimistic people. At the bottom row, those are people that in February were very optimistic. The expected returns above 10%. Okay? Now, what these different columns are, they represent the changes in the beliefs, in expectations between February and March. Okay, so for example, this first column is basically those people that they revised downwards their expectation by more than 20%. These ones are people that revise their expectation down by 10 to 20 percentage point, all the way to people that revise upwards their expectation by more than 5%. So these arrows here, they represent kind of the change in expectation. So those are in the first four columns, are those that become more pessimistic between February and March, and those in the last two columns are those that become more optimistic. Okay, so now for each row, what you see here basically is the density, is basically the distribution of changes in behavior for each being. So let me walk you through an example. Let's look at the optimists. Okay, so these are people that in February, they're very optimistic. What happens to their beliefs between February and March? So 4% of those people, they become really pessimistic, much more pessimistic. Okay, so they drop their views about the future by more than 20 percentage points. 29% of them, of this being, become more pessimistic, but they revise downwards their expectation only between 10 to 20%, and so on, okay? Up to the very last being, which says that only 8% of the optimists become even more optimistic, and they increase their expectation by a further 5% after observing the crash, okay? So now, what does this number tell us? Well, there's a very simple point here, which is basically, if you just sum the mass of people who become more optimistic, which is the last two columns, you get this number here, okay? So what do you see? You see that a very small number of people becomes more optimistic in the last being and the previous two beings. So basically, just like the average numbers I showed you before, almost every being becomes very significantly more pessimistic, right? The vast majority of people throughout each of these beings becomes more pessimistic, with one exception, which is those that were already very pessimistic. Of those, about half become more pessimistic and half become more optimistic, okay? Now, you might wonder whether this is just purely driven by mean reversion. That's not the case, okay? So one of the things we try, we say instead of measuring your ex-ante expectations, your ex-ante optimism by your answer in February, we can look at your fixed effect over the last several waves. We get very similar results, okay? So what this is saying is that, you know, it's not just that the average person becomes more pessimistic over this, you know, as the crash is occurring, but the response is being very heterogeneous across beings. For in particular, the pessimists, you know, many of the pessimists actually become more optimistic, right? They were pessimistic to start with, they saw a crash and they say, okay, that's as far as it goes, going forward, things are gonna recover. That's what we see in the data. And so in the last 5 minutes, I want to talk instead about beliefs and trading, which is really the key of our analysis, okay? So we're going to look basically, again, at different people that differ by their optimism, and we see not only how their beliefs change over time, but also how their trading changes over time. And I'm going to give you a quick preview of our results before showing you the numbers. One of the first striking things that we see is that despite the fact that many people, basically everybody, changed dramatically their expectations, actually very few people even trade, okay? In fact, 70% of the responses in our survey, they don't change their portfolio at all. So they don't even trade at all, okay? So then what we see is we look at, you know, for those people that do trade, what do they do? And we do see flows from equity and bonds towards cash, okay? Mostly from equity to cash. But even then, the numbers are small. So even on the intensive margin, those people that do trade, they change their portfolio just by very little. So when you combine the fact that, you know, the extensive margin is very inelastic because many people don't trade at all, and the intensive margin is also kind of inelastic because people trade very little even when they do trade, the overall flows out of equities are just tiny, okay? They're just less than 1% of portfolio shares. And that's a striking result that you know, it's particularly striking when you think about the magnitude of the change in expectations. Now, let me show you a couple of these results. Okay, so this is again a plot of what happens during this period. This solid line again is what happens to S&P 500. Now, these three lines that you see here is the evolution of the portfolio trades only for those people that trade. So I'm already removing all those people that don't trade. And here, what you see here, the axis is the equity share in their portfolios. So just, if you look just at the beginning, what happens in February, what do we have? We have the, you know, in February, these are the optimists, okay? These are the people that expect a high one-year stock returns. they held 67% of the portfolio in equities. These are people with intermediate beliefs, and these are the pessimists. The pessimists only had 57% of the portfolio in equities. So you already see that our survey is capturing something useful, because there is indeed a spread in the portfolio shares between the optimists and the pessimists. Okay, the optimists do indeed tend to hold more equities than the pessimists. Now, these lines tell us how their portfolio shares evolved based on their optimism. Okay. Now you may wonder, well, but don't portfolio shares change because prices change? Well, it turns out that what we did here, we keep the prices fixed as of the end of January. So the portfolio shares you see here, the changes are due entirely to active trading. Okay, they're not due to changes in market prices. And what do we see? You see that even the optimists, that are the ones that change the portfolio shares the most, their portfolio shares drop by, let's say, at most 4 to 5%. It's not zero, okay, but it's not a huge amount given how much their expectations changed. You can see that the optimists are the ones that change the portfolio shares the most. The ones with intermediate beliefs, they change by less, and the pessimists, they don't really change the portfolio shares much, which is consistent with the idea that really of those who are pessimists, actually half of them became more pessimistic, but half of them became more optimistic. Okay, so that's why you see the most of the action happening in the pessimists, in the optimists, sorry, they become more pessimistic and they start selling equities. Okay, now as I said, this graph here was for only those people that traded. Now, if I combine those people that traded with those people that didn't trade, what do you see is very little flows out of equities, about 1%, and mostly concentrated among the optimists. Okay, so this basically tells us that there's a striking amount of inelasticity of the portfolio trading, on the trading activity, on the part of these vanguard investors. And so I want to conclude in the last couple of minutes by just giving you some of the results, but actually saying something about what they imply for theory. Okay, I don't have a coherent theory, one unique theory that explains all the results, so I'm just going to point to some suggestive directions. So we really have two sets of results. One is on the dynamics of beliefs, and one is the dynamics of trading. Okay, so what do we see about beliefs? The investors tend to become more pessimistic about the short term. That's after observing a huge market crash. That's consistent with kind of extrapolative behavior, which has been documented in other surveys as well. We also see that after the crash, people increase their perception of risk of further crashes, which is consistent with what we had seen in some of the rare disaster models. And I think it's also consistent with what Ralph mentioned at the beginning, could be an explanation for why prices dropped so much, which is that, that there may have been some sort of limited effect in the short run, but people also increase the probability that in the long run, we're going to be hit again by some further disaster. That would certainly be consistent with our data. And then there's an interesting increase in disagreement, and certainly there's heterogeneity in belief dynamics, which suggests that maybe representative agent models may miss some interesting dimensions of our data. And then on the analysis of trading, really the most striking result is that there's very low elasticity of basically the demand for these assets and the flows relative to the change in expectations. And that's also talked to some of Ralph's other work about the elasticity of, instead institutional investors with respect to price changes. But, we think that it's very important, if you want to understand what moves market price, it's very important to understand which investors are elastic, which are not elastic, and how the elasticity relates to the characteristics of investors. It basically is a key point of transition mechanism of shocks to beliefs and prices into action. And I'm going to conclude there, and thank you very much for inviting us here.
Thank you very much, Stefano. So now the idea is we like to have a discussion between the panelists. I guess there are a lot of overlapping topics here. Maybe I'll just raise a few points. Maybe I ask a few clarification questions, and I'll pass the word, and I'll try to collect some of the questions that we've been getting here. I guess we had a discussion about inelastic demand here. Rolf has been working a lot on that, and I guess is confirming your hypothesis somehow, or how it's related to the work you've been doing. And I guess the question that I have is also we are looking at a segment of the market in the case of Stefano's paper. Yeah, so how we see the full portfolio of these investors, what is happening with institutions, and with the
Yeah.
as well. Yes. So
Okay.
we'll go to the next topics, I guess, later. Yeah.
Yeah. So I think so if it relates to the aggregate stock market, so then it's kind of like so I think it's important to make a distinction between two things, and I'll get to your question. So one is sort of a micro elasticity, meaning like suppose I swap like Google for Apple, and actually Harrison I think is like one of the like nicest papers on that, sort of like to identify sort of the micro elasticity, and that one is typically order of magnitude like I think around 1, and Harrison's going to tell me if he thinks it's different from 1, but I think order of magnitude 1, meaning I buy 1% of Apple, I'm going to move prices by 1%. Now there's a separate elasticity, which is the macro elasticity. Like if I sort of switch out of like bonds and I buy equities, how much do I move prices? And so that one I think is actually a lot less elastic. And in all of our models, it's like a lot less elastic. And so in some recent work with Aggregate, we're sort of trying to estimate that one, and we get to something like elasticity, something like 0.2. So it means like by 1% of the market, you move prices by 5%. Now, what is the sort of like some evidence that's very consistent with what Stefano was talking about across other recessions is that, first of all, generally flows are like really, really small. So the typical capital reallocation across sectors is something like 0.5% of the total amount of shares outstanding. So seeing a flow into the aggregate stock market in the US, which is something like 30 trillion of like 100 billion, is a substantial flow, which is kind of surprising, I think. So these flows are really, really small. The second sort of like observation is that during the 2001 recession and 2008 recession, the largest outflows came from households, but they're still very small, something like 0.5% of the market. And then you can ask the question, well, who stepped in? Who provided elasticity to the market, if you wish? And the ones who are buying one is the foreign sector, and it's actually state and local pension plans. And so it's not like your typical sort of group of investors who you think are very elastic sort of like investors. Other institutions you may think about that rush to the market to sort of like provide elasticity would be perhaps something like hedge funds or global macro funds. They actually, like during bad times, typically they either experience outflows, risk constraints, buying, and so on. And so there's like you can sort of directly measure it, and they actually sell during those episodes as well. So they're surely not stepping in. And on top of it, they're actually very small. So they just manage like hedge funds in total manage just 4% of the market. And so I think in answering that question, like how elastic is the aggregate stock market, which I think is a really important question. I think if you look at you go institution by institution, I think a lot of them have fixed mandates. They're like 70-30 stocks and bonds, and they just can't sort of like provide much elasticity. And so as a result, whenever you see these like fairly small flows, like what Stefano was talking about, the other thing to realize is lots of people who don't respond, and it means that these small flows can actually have a big impact on prices. And so I think it's very consistent with that. And I think it reconciles like Stefano's other paper, I think, with the stock market volatility. So beliefs are volatile. They lead to a small pass-through in terms of actions, but then they're met in inelastic markets, and that's why prices are volatile. So that's one narrative, I think, that's seemingly consistent with the data.
Yeah, I agree. I mean, I completely agree with that. I think it's very consistent. I mean, I think that I view basically, I think that Ralph's results are very interesting because they point out to this macro inelasticity. And I think kind of we want to I see what we're doing as kind of contributing to understand where this macro inelasticity is coming from. Basically, because obviously our these retail investors that are are a big chunk of the retail market that is actually determining the various flows, right? So I think we want to start from the macro number and say, okay, but where is that coming from? Let's kind of go to different segments of the market and see how all these pieces interact to give us this macro elasticity. And so it's kind of going to that direction. Try to bridge the micro and the macro numbers.
And also let me add one small point, which is sort of on the theory side of things. Pretty much all asset pricing models, both rational and behavioral, imply very high macro elasticities, something order of magnitude like 20. And so that means that the micro elasticity, Apple versus Google, in all of our models is way higher than the macro elasticity. But the macro elasticity implied by all of our macro finance models is way higher than the very well identified estimates that Harrison and others have documented. And so there's already like a big disconnect there between sort of like elasticities, which I don't think kind of was sort of like, it's not something we realized before it was Xavier. Is that like in all these models, what happens is that beliefs, let's say in behavior model, beliefs are really volatile, or risk aversion is very volatile, in order to be met by very elastic markets. And so we think that part sort of like is something that, like from a theory perspective, like why are markets so inelastic? I think is a big question.
Okay. Any questions between yourselves? I guess I can ask another one, but
yeah. So I actually had a couple of questions. So Ralph, I have one for Ralph and a couple for Alison. So for Ralph, my question was, So what do you think is going on at the long end? So what's happening at short end is very clear because we see the price of this dividend stream. So are you decomposing what happens at the long end into basically long end cash flow news and long end discount rate news? Or my understanding was your view was that it's more cash flow news, but maybe I'm wrong. Maybe I didn't. I just want to make sure your views on this.
No. So on the long end, no. So that's so on the long end, it's I think it's all the standard evidence that is mostly discount rate news.
Okay, but then
on the short end, I think the short end, like here's one way to think about it, right? So imagine that the short end would go. Obviously, there's like short-term discount rate variation, but imagine that the short end goes completely off. Then it's very easy, quote unquote, to arbitrage it because like these are like this contract is going to mature in like let's say 6 months from now or a year and a half from now. And suppose it would trade at massive discounts, I can trade directly back to fundamentals pretty easily and hold on to it. With the stock market, we can have like very long swings, and then of course the question is like where do swings come from. So for the long end, it's all the evidence by Campbell, Shield, and Cochran and others on discount your work on discount rates. So,
I was just wondering if you're like exactly okay. Okay, and then instead, I had a question for Harrison about the nature of these stochastic transmission rates. What do you think about that in the sense that there's many reasons. So what do you have in mind when you think about these? So you're capturing in reduced form what are the transition rates, but I think it's very important to think about the nature of this transmission, of these shocks to the transmission rate. Because for example, you could have are you thinking of these as kind of exogenous shocks? For example, I don't know, virus mutations and I don't know, changes in unexpected changes in activity that end up affecting transmission rates? Or are you thinking, for example, of random shocks to policies because, one day some politician wakes up and does some, enacts some policies. So I think it's important to think about what part of the stochastic shocks are exogenous versus endogenous because it really matters for how we design policies in response to this.
Sure. Yeah,
actually, just to complement here, like Marcelo Fernandez was asking a question about different ways of modeling the stochastic, the transmission rate. I don't know if you saw that question there, but
yeah. So I mean, we think about the model as absent intervention. So you should definitely model the intervention, right? So that you can definitely take this process and then kind of work out an optimal intervention policy. So Nung and I and Jinjiang are trying to do some of that. I mean, it's a little bit more involved, but basically you can think about in two types of processes. One is the sort of reduced form stochastic transmission process that captures pathogen mutation. It also captures what some of the mathematical epidemiologists like to think of as some network dynamics, in the sense that, when you have networks and you think that basically there are these potential kind of quote unquote super spreading events, it can capture some of that. So I think that's kind of what the math epidemiologists think about. So that's what I think about it. As economists, we should definitely also then take such a reduced form process and then of course write down an optimal suppressed process or potentially a non-optimal, some type of, you want to have some type of control on that, so I think that's the way I think I would think about the thing. So at this point, this is purely an exercise in kind of talking about what happens when economists use deterministic models, right, versus a stochastic model to generate counterfactual infection forecasts absent intervention. Okay, so I think that's sort of but for sure, I think if you want to talk about policy, you definitely want to have an optimally suppressed process, which I think is also kind of pretty interesting now, because I think then you can talk about what's kind of an optimal suppressed path and what happens when the policy deviates from that path, right, in some way that you can kind of capture some political cost or something like that.
May I ask another question here? I guess we talked about Harrison to mention vaccines and the potential of vaccines, and I see this problem as a combination of a short-term problem and a long-term problem. Rolf mentioned that as well. So how does it affect, and the markets have been reacting a lot about news of vaccines. So Rolf, for example, what has been the correlation between the short end of this curve with the long end? Whether they've been moving a lot together? Stefano, I guess you look at a 1 year and 3 year expectations are they aligned and moving together really closely for different individuals? And like how this affects the pricing of like if you change a lot of these expectations? I guess Harrison mentioned the results as well. Like what if we change the vaccine expectations, the probability of seeing it faster or lower, how it affects the prices in your model? I guess like this is the long end. Are we talking about levels or growth? Yes, I guess, for example, in the Roth's case. So everybody's associating the level effect today with the growth effect in the long term.
So yeah, maybe I'll jump in and Ralph and Stefano can kind of jump in a little bit. So I want to kind of say on the vaccine thing, I looked a little bit at Ralph's paper at the end, but you know, I think kind of one model of the vaccine is that there's some time that this vaccine comes, you're kind of back to so they think about it as like a pre-pandemic regime, a pandemic regime, and a post-pandemic regime. But I think in between, there's actually quite a lot of additional parameters you need to, or like economics you have to kind of do, which is you could think about, when the vaccine comes, do we go back to the way we were, right? Or like, i.e., if the vaccine doesn't come, you know, what are the different growth rates? So I think I guess Ralph's estimates encompass, I think, both a vaccine, some expectations about vaccines really, right? And also basically about the reflation scenario. Does that make sense, that question?
Yeah, so I think the short end, so we haven't looked at this sort of like on the pure announcement effect, but during the first and the third sort of like periods, like long and short end markets move a little differently. So in the first period is the long end that sort of comes down, short end doesn't move. Second, they move together, of course. And then the recovery has been sort of like largely the long end, and the short end has been kind of stuck for the play. If we get a vaccine, there's going to be time to produce, there's going to be time to distribute, and that's sort of the short-term damage is being done. And then I think Harrison makes like really interesting points in terms of like what will the world look like after that? Are we going to get more worried about pandemics in general? Do we learn how to work from home? Like the types of cities, lots of things that could change. And of course, these prices that we're looking at, they will reflect all of that. And so yeah, so I think it's really interesting to sort of understand that better. And so to look at that, we haven't done sort of like these like event studies around vaccines. But,
yeah, so we haven't. So go ahead, Harry.
Go ahead, Stefano.
So, you know, we also didn't do a, kind of event study, and that would be interesting. I mean, for us, it's a bit complicated because, of course, we don't have continuous price data. We need to actually, either we run a survey really, really fast, or we just are lucky that the vaccine happened just before our survey. But obviously, whatever we're getting out of our surveys, they are, they're incorporating the expectations of vaccines. And one of the things that I didn't talk about in the presentation because of time issues, but, what our investors are showing is that there's a lot of action in the short term, so very high risk of disaster and very low expectations of growth and so on. But the long end is actually very stable. At least in the three ways we had, there's basically zero correlation between the movements in the short term and the long term, and the long term is very, very stable. So I guess also the point is that I think different sectors of the economy might just have different views about the future, or they might be concerned about different things. And, it would be interesting. It's a difficult task to kind of square all of these different angles.
Yeah, because I think one of the kind of interesting questions that's out there is guys that are part of the old economy, so i.e. all of the economy that's been really severely impacted with pandemic, versus the guys in the digital economy, right? These are all the guys who've sort of been benefiting in some sense, absent travel and stuff like that. So there's a kind of a big debate exactly about, do we go back, when, let's say the market is right. I think the market is expecting a vaccine fairly fast. It's kind of thinking like a year, something like that, okay? But if you look at valuation, so it's true that I think the Apples of the world have done great, but you know, the Disneys of the world, right? All of these guys, you know, they're clobbered, you know. And I think there's a big debate in some sense. The disagreement is that guys who run these clobbered industries are kind of yelling at investors that, hey, you know, the world is going to go back to normal. You know, people are still going to want to like travel. They still want to go to Disney, you know. Zoom is not that fun, basically. We're still going to be in Brazil next year, yeah. And I think that's this is a huge debate because like I think there's just like a massive debate among these guys. They keep yelling at each other. In fact, the CEO, Barry Diller of Expedia is really funny. You know, he has this thing. He's like, what rational person would want to extrapolate out into the future when you're in a pandemic, you know? Because all his companies have been clobbered. Like every one of his companies have just been like Expedia, Match.com, nobody's going on dates, nobody's like, you know, so almost everything has just been a total disaster for him. And he's just been screaming at all these investors. But I think these are very kind of interesting questions about growth actually, generally from the COVID that, you know, after disasters, right? How does kind of, you know, do you go back to normal and what are the redistributive? So it'd be kind of interesting, I think, for Stefano, if you could run a survey, right? To kind of tease out a little bit, both, I think, kind of the vaccine aspect, because I think the expectations embed, I think, multiple interesting economic features about like, you know, when people think the vaccine's going to come, when the thing will, you know, if it comes, right? Do you go back to normal or not, right?
Yeah. I mean, the other thing that we could potentially look at, which we have not looked at, which goes in the direction, is we could look more at the portfolio composition, because right now we're just doing equity versus bonds. But potentially you could see, you know, we actually see, you know, these people mostly hold, you know, funds, ETFs, mutual funds, but they also hold individual stocks. And you could very easily think of, you know, shifts, for example, of portfolios towards growth stocks or towards, you know, tech stocks and so on. We have not looked at, but you would go in that direction.
No, I mean, I think for sure, I think if you look at the valuations, I think the reason Barry Diller and all these value guys are so upset is that all of the retail investors have flocked into Tesla, you know, and, you know, it's basically, I think the thesis is the world is going to change even faster after the COVID. You know, I think this is kind of the big debate out there. You know, I don't think there's much of a debate anymore about when the vaccine is coming. I think vaccine is coming. I think really the big debate is what is the world going to look like post-vaccine, you know, and I think and I think a lot of the unemployment numbers also reflect in some sense that these types of heterogeneities that we're kind of seeing in the valuations that, you know, I think all of the old economies are the ones that were employing a lot of people, right? You know, whereas, you know, basically Tesla is proposing that every car be like robotic, you know, and then nobody drives anything, you know, on their like new robot fleet. So it's just a very exciting, I think, kind of time for a lot of interesting kind of economics as far as, you know, these sorts of questions. So.
I think the other aspect, I think that I know we have to mention, I think if we try to understand financial markets now, is that the giant elephant in the room is, of course, the role of like governments, right? Central banks and fiscal policy. And I think one thing we've learned is that they're willing to go way beyond like what we even have seen in 2008. And so that may help a lot to sort of like make this a short recovery, because as soon as there's a vaccine, like quite likely they'll do whatever sort of like they can do to get people back to work and all kinds of incentives. And that may help a lot, at least sort of the US, Europe, and so on, to sort of like make this a much shorter like downturn than it otherwise would have been. So the role of government intervention going forward in asset pricing is sort of like front and center, it seems. And it's very unprecedented compared to like even 2008.
Yeah, and not just the government, you know, in terms of actual economic activity, but also like all the stuff that the Fed has done on directly on financial markets, right? That just huge effect on valuations. Absolutely.
It'll be easier to search for yield. Yeah, you have someone there to buy the assets from you if you need to sell as well. Yeah. We had a few other questions. Maybe a question for Stefano here. I guess like you showed the averages of the investors somehow, yeah. So, but did you see a lot of trading happening from investors, like the ones that became very optimistic? Were they more likely to trade? So the pessimistic that became suddenly very optimistic. Okay. And so, did you see updates in the expectations after they traded? I guess that's a question from Andre Lot. So how interaction between the two that happened in the data?
Yeah, so we haven't really looked at that here. part of the problem is that there's a bit of a synchronicity problem because they could trade at any point in time, but we actually only observe the survey. We only observe the expectation at some point, right? And, you know, we observe basically expectation once a month. So, you know, if you have traded 2 weeks ago, it's difficult to know if you like. So we didn't look at that. In general, we didn't go very deeply into the kind of the causal relation between trading and beliefs, you know, which comes first. You know, basically we're just showing some correlation, the fact that, you know, and then we did like more extensively in the other paper, just basically showing that, you know, those are optimistic at trading, you know, they're holding more equities, but we didn't look at this kind of, you know, are they more optimistic because they bought more equities and they kind of try to justify why they bought more equity and so on. So we didn't go there, but there's a lot more we can do for sure on that.
Sure. Any other questions? So I guess we finish our time here. So I would like to thank you very much for participating. It was an amazing session. And once again, I don't need to repeat it again. I hope you come soon. Harrison's coming next year for sure, if we can do it. Yeah. Stefano, I guess we have invited you a few times already, and Rolf would like to see you again here. It was great. And,
thanks so much.
Back soon as well.
Thanks all for organizing.
It was a great talk. Thank you very much for all. Yes.
Thank you guys.
Bye-bye.
Bye.
Bye-bye.